Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 31st March 2020 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad, or the company, solely for general information purposes and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs and projections about future events or matters. By listening to and or viewing this webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today comprises 6 components. In part 1, Uday Jairam, our Senior Vice President, Corporate Development, will briefly introduce the company. In part 2, Dr. Pascal Hoss, the CEO of Sea Hibiscus Sendirian Berhad, will provide an overview of a Not Sabah Malaysian producing asset. Golok Ravi, Corporate Coordinator for the Anasuria asset, will provide an overview of and an update on developments at our UK producing asset, the Anasuria cluster, in part 3. In part 4, Mark Payton, the CEO of Anasuria Hibiscus UK, will then provide an overview of the status of the development project relating to the Marigold and Sunflower discovered oil fields located offshore in the UK continental shelf. In part 5, Yip Chi Yong, or CY, our Chief Financial Officer, will present the highlights of the group's financial results for the third financial quarter ended 31st March 2020. Kevin Robinson, our Vice President Special Projects, will then conclude our presentation with some of our key messages for this quarter in part 6. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now hand over to Uday.
Hello, this is Uday Jairam. I'm the Senior Vice President, Corporate Development at Hibiscus Petroleum Berhad. Let me commence this presentation by providing you with a brief introduction to our company. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011 with the vision of being a respected and valuable pure-play, independent oil and gas exploration and production company. Our 2021 mission is to secure 100 million barrels of net proven and probable, or 2P, oil reserves and or entitlement, and achieve a net production of about 20,000 barrels of oil per day from currently held assets or potential new ventures located in areas of our geographic focus. We have approximately 1.6 billion shares in issue. These shares are held by more than 26,000 shareholders, with our core management team owning the largest single block of shares in the company with a 10.6% holding. Other corporate and institutional shareholders approximately hold a combined 35% in the company, while retail shareholders provide liquidity with circa 54% ownership. On the 15th of May 2020, our market capitalization stood at circa 921 million ringgit. Hibiscus Petroleum is a component of the MSCI Global Small Cap Index as well as the FTSE Bursa Malaysia Mid 70 Index. In addition, our listed securities are Sharia compliant. Issued in March 2018 and set to expire in March 2021, we also have approximately 317 million warrants outstanding. The exercise price of these warrants is currently at 1 ringgit 12 sen. Today, our key activities are focused on efficiently monetizing our producing oil fields and growing our portfolio of development and production assets in areas of our geographical focus. These areas are the United Kingdom, Malaysia, and Australia. The company currently has 2 production assets, the first being the Anasuria cluster of oil and gas fields located in the UK North Sea, which we acquired about 4 years ago. Since our acquisition of this asset, the Anasuria cluster has contributed significant positive cash flow and profits to our company. Over the third quarter of the 2020 financial year, the Anasuria cluster delivered an average of approximately 3,200 barrels of oil equivalent per day, net to our company. In addition to the Anasuria cluster, we became the operator of the 2011 Not Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC, on 31st March 2018. We have a 50% participating interest in this PSC, with the remaining 50% non-operated participating interest being held by Petronas Carigali, a wholly owned subsidiary of Petroleum Nasional Berhad, or Petronas, the national oil company of Malaysia. For our 50% participating interest in the Not Sabah PSC, our estimated entitlement of daily production over the third financial quarter was approximately 6,400 barrels of oil. In summary, the total oil and gas production rate across both assets averaged approximately 9,600 barrels of oil equivalent per day over the third financial quarter, of which oil production accounted for 9,200 barrels per day. Within our current portfolio of assets, our total net proven and probable reserves as of 1st January 2020 stood at 49.7 million barrels of oil, while net contingent oil resources stood at 72.8 million barrels. Financially, our balance sheet continues to strengthen. As of 31st March 2020, our net assets stood at 1.4 billion ringgit, and our unrestricted cash balance stood at 57.1 million ringgit. Our current portfolio, consisting of 2 exploration, 2 development, and 2 producing assets, is spread across 3 continents. In Asia, we are present in Malaysia, where we operate a production sharing contract, or PSC, covering 4 producing fields. The North Sabah PSC, as it is called, contains net 2P oil reserves of 20.4 million barrels of oil as of 1st January 2020. In addition, our net 2C oil resources in the North Sabah fields amounts to circa 29.5 million barrels of oil. In Europe, we are present in the United Kingdom and have interest in several fields under concession agreement type arrangements. Firstly, we jointly operate several producing fields in the Anasuria cluster. In addition, we have a non-operating interest in the Cook field, which is a tieback to the Anasuria Floating Production, Storage and Offloading, or FPSO, facility. Based on an independent assessment, the total net 2P oil reserves in the Anasuria cluster are 22.8 million barrels of oil as of 1st January 2020. Another 7.8 million barrels of 2C oil resources net to the company are located within the fields of the Anasuria cluster. Secondly, we are also the operator of Blocks 15/13A and 15/13B, a development asset in the Quad 15 area of the United Kingdom continental shelf. These blocks include the Marigold and Sunflower discovered oil fields. We believe that material contingent resources are located in the Marigold and Sunflower oil fields, in which we have a 50% interest. These 2 discovered oil fields are estimated to contain approximately 30 million barrels of 2C oil resources net to the company. We also completed the acquisition of Blocks 15/18D and 15/19B, potentially also a development project in the Quad 15 area. These blocks include the Crown discovered oil field. Circa 4 million barrels of 2C oil resources are contained within the Crown discovered oil field. In the months and years going forward, we intend to gradually convert these contingent resources into proved and probable reserves, or entitlement barrels, thereby further enhancing the value of our asset base. In Australia, under a concession-type agreement, we have approximately 6.5 million barrels of 2P oil reserves, located in the Vic L31 West Seahorse development asset, which we operate. Finally, in terms of exploration assets, we also operate the Vic P57 license, which we believe contains exciting opportunities. In the Vic P57 license, 2 key prospects have been identified. The first is Felix, with best estimate prospective resources of net 23 million barrels of oil, and the second being Pointer, with best estimate prospective resources of net 128 billion cubic feet of gas. We currently have a 75.1% direct interest in Vic P57 and are now in the process of farming out the license. We also recently exercised an option to acquire a non-operated 50% interest in the Vic P74 exploration license, located in the same area as Vic P57. Given existing market conditions, we may encounter difficulties developing some of the opportunities within our portfolio. We are currently embarking on detailed technical and commercial work seriatim, which may result in the reprioritization of some of the opportunities in our portfolio. The chart on your screen depicts the group's targeted average daily oil production by 2021. In previous disclosures, we have said that our target for the 2020 financial year is to deliver 3.2 million barrels of oil across both the Anasuria and North Sabah assets. Given existing market conditions, we intend to produce 3.2 million barrels, but we may delay the offtake of some of these barrels into the next financial quarter to take advantage of better crude oil pricing that we see in the latter half of this calendar year. In order to achieve our 2021 mission of producing 20,000 barrels of oil per day, our main focus will entail enhancing production at Anasuria and the North Sabah fields, and positioning for further acquisitions of producing assets in our areas of geographic focus. I'll now hand you over to Pascal to provide a business overview of our Malaysian North Sabah operations.
Hello, I am Pascal Hos. I'm the CEO of Sea Hibiscus Sendirian Berhad. Sea Hibiscus is the holder of a 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. We are also operator of this PSC. The remaining 50% participating interest is held by Petronas Carigali Sendirian Berhad. This is our first PSC in Malaysia, and our participating interest was acquired through a transaction with the Shell Group that was successfully completed on the 31st of March 2018. The North Sabah PSC has delivered production since 1979, and our production rights under the PSC continue until 2040. Through the PSC and the joint operating agreement signed with our partner, Petronas Carigali, we have a 50% participating interest and operatorship of 4 producing oil fields offshore Sabah, namely St. Joseph, South Furious, SF30, and Barton. We also have the operatorship of the Labuan Crude Oil Terminal and all other equipment and assets related to the PSC. As reported by our independent technical valuer, Risk Advisory, based on our participating interest and adjusted for actual historical production and internally estimated incremental reserves derived from executed projects in 2019, the net 2P oil reserves of the fields under this PSC is 20.4 million barrels as of 1st January 2020 through to the end of the PSC life in 2040. The 2C contingent oil resources in the fields covered by this PSC is 29.5 million barrels. This data, sourced from Risk Advisory's report, is based on our net entitlement less 2C contingent resources for executed projects in 2019. Thus, we believe this asset holds a great deal of future potential. Subject to oil price and regulatory approvals, we hope to be able to allocate capital and our technical capabilities towards unlocking the available 2C contingent resources. The table on this slide shows the operational performance of the North Sabah asset over the past 4 quarters. That is from 1st of April 2019 until the 31st of March 2020. During the current quarter, North Sabah production facilities recorded an average uptime of 89%, with gross oil production slightly higher than the previous quarter. Average OPEX per barrel for North Sabah for the current quarter increased marginally to $13.16 per barrel, primarily due to the commencement of commissioning activities of leased equipment related to the South Furious 30 Waterflood Phase 1 project. Furthermore, during the current quarter, we conducted 2 crude oil offtakes with a total of approximately 611,000 barrels of oil being sold at an average realized price of $47.72 per barrel. Overall, we are pleased with our operating performance for this quarter. In the current quarter, we received 4 Focus Recognition Awards from Petronas in relation to our 2019 drilling campaign. 3 of these awards we received in January 2020 from Petronas Completion Standardization Technical Committee. One was for our overall uptime performance of 99.7% during the 7-well drilling campaign at the St. Joseph and SF30 oil fields. The achievement of a high uptime resulted in an estimated cost avoidance of $2 million. The second award, won in January, relates to our success in designing, planning, and replicating the autonomous inflow control device in the 3-well St. Joseph campaign. This contributed immensely towards reviving the production level in this field by enabling commingled production from multiple sands through the lowering of GOR from 6,000 to 800. The third award was for successfully designing, planning, and safely implementing new technologies and process optimizations for wells at North Sabah, resulting in improved well life. Additionally, we received the Focus Recognition Award in February 2020 for demonstrating effective well planning in 2019. This was able to maximize long-term value to the asset and meet production demand at an effective cost. We continue to work towards aggressive production targets and pursue cost reduction opportunities without compromising the high health and safety standards that are expected in our industry. Referring to the project shown on this slide, the SF30 Waterflood Phase 1 Project Development Plan was approved by Petronas in October 2019, with water injection planned to commence in May 2020. Phase 1 of this project is intended to assess the long-term viability of a full-field water injection development project. It entails the drilling and completion of one infill water injection well through a new conductor, with the goal of scoping out the effectiveness of water injection as a means of repressurizing and providing long-term reservoir pressure support for the SF30 field. Total capital expenditure for Phase 1 is budgeted to be approximately 55 million ringgit and is being shared equally with our joint venture partner. As of 31st March 2020, 53.6 million ringgit had been spent, with the remaining 1.4 million ringgit to be spent in the financial quarter ending 30th June 2020. We are currently working towards maturing our 2020 drilling program comprising infill wells at the St. Joseph field, targeting the major and minor sands. Further information will be disclosed in the next financial quarter. The 7-well drilling campaign of 2019 and our plans for 2020 are consistent with our objective of enhancing production from the North Sabah asset, and it demonstrates that Malaysia is an integral part of our long-term growth strategy. Goloka will now take you through the details of the Anasuria cluster, which is located offshore the United Kingdom, in part 3 of this webcast.
Hello, I'm Goloka Ravi. I'm the corporate coordinator for the Anasuria asset. I'll now take you through some information on the Anasuria cluster. Our indirect wholly owned subsidiary, Anasuria Hibiscus UK Limited, or AHUK, has been involved in the joint operations of the Anasuria asset for over 4 years. This asset is located about 175 kilometers east of Aberdeen, in 94 meters of water, and has been in production since 1996. Based on an independent reserves assessment conducted in 2018 and the assumptions contained therein, the estimated remaining economic life of the asset is up to 2038. Our interest in the Anasuria cluster comprises a 50% direct interest in the Teal South, Guillemot A, and Kite fields. We jointly operate these fields together with our partner Petroleum through a jointly owned legal entity incorporated in the United Kingdom called the Anasuria Operating Company Limited. We generally refer to the Anasuria Operating Company Limited as AOC. The cluster also includes the Cook field, and in this field we have a non-operated 19.3% interest. We also own a 50% direct interest in the Anasuria FPSO. Included as part of the Anasuria cluster are all components of the installed subsea production infrastructure and the Anasuria FPSO. Taking a closer look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. We utilize the services of Petrofac, a reputable international oil field service provider, in the role of duty holder for the offshore facilities, pipelines, and wells. Our joint ownership of the Anasuria FPSO and management of operating costs through a risk-reward type arrangement with Petrofac are key drivers in keeping our unit production costs at competitive levels for this type of facility. In Anasuria, the average uptime achieved for the quarter was 90%, while the average daily oil equivalent production rate was 3,177 barrels of oil equivalent per day, both metrics being an improvement when compared to those achieved in the previous quarter. One crude oil offtake was conducted at Anasuria, in which approximately 239,000 barrels of oil net to AHUK was sold at an average realized oil price of $50.59 per barrel. The average OPEX per barrel of oil equivalent in Anasuria for the current quarter was $14.92. This relatively low OPEX was driven by a combination of reduction in costs due to the low oil price environment, deferral of activities to mitigate COVID-19 risks, as well as the optimization and timing of maintenance activities in calendar year 2020. Operationally, a significant review of our operating strategies, maintenance systems, and organizational capability is ongoing as part of an overall initiative to carefully manage costs. Planning continues for a 40-day offshore turnaround of the Anasuria FPSO in financial year 2021 to improve its reliability and integrity. Whilst planned maintenance initiatives affect operational performance, these activities are critical enablers of a safe working environment and overall can lead to an improved performance of the offshore facilities. Barring unforeseen circumstances, these measures, together with the production enhancement projects on the next slide, are expected to improve the operational performance of the Anasuria asset. Referring to the projects itemized in the table on this slide, the Cook Water Injector project, which was sanctioned in May 2018, consisted of two phases. The first phase entailed the drilling of a well through which water will be injected over the coming years to repressurize the Cook field. The second phase covered the installation of a pipeline connecting the new well to the water injection pumps located on the Anasuria FPSO. Both the first and second phases of the project have been successfully completed. In drilling the water injector well, reservoir pressure at the injection well location was found to be as predicted. Additionally, the oil-water contact was determined to be deeper than originally anticipated. The implication of a deeper oil-water contact is positive and is anticipated to increase our net 2P reserves in the Cook field. We will make a further disclosure when the detailed work to establish the latest reserves estimates has been completed. The installation of a subsea pipeline to link the water injector well to the Anasuria FPSO was carried out in the previous quarter, and injection of water into the Cook field reservoir commenced on 3rd October 2019. Our total net capital expenditure for this project is 58.8 million ringgit. Approximately 30,000 barrels of water per day was being injected into the reservoir until December 2019, when the injection of water ceased due to a failure in a subsea component. Whilst the water injection activity has ceased, production from the Cook field is progressing as expected at the current time. Reinstatement of the water injection is expected to complete by the first quarter of calendar year 2021, and the incremental cost to AHUK is estimated to be 2.5 million ringgit. For the subsea debottlenecking project and future infill wells, the subsurface studies and technical assessments are currently ongoing, and further disclosures will be made as these projects progress. I will now hand over to Mark, who will give you an overview of the Marigold and Sunflower assets.
Hello, I'm Mark Payton. I'm the CEO of Anasuria Hibiscus UK Limited. I will now briefly take you through the key points of our interests in blocks 1513A and 1513B. These are development assets which are located in the United Kingdom. As you may recall, on the 17th of October 2018, we announced that our indirect wholly owned subsidiary, Anasuria Hibiscus UK, had completed the transaction to acquire a 50% interest in blocks 1513A and 1513B for a total purchase consideration of $37.5 million. The blocks are located offshore in the UK sector of the North Sea, approximately 250 kilometres northeast of Aberdeen, in water depths of 140 metres. Block 1513A consists of a significant oil-bearing discovered field called Marigold, whilst Block 1513B, which lies northeast of Block 1513A, consists of a smaller discovered field called Sunflower. Based on an independent report by AGR Tracks International Limited, the gross 2C contingent oil resources in the blocks are estimated to be 60 million barrels of oil. As we have 50% interest in the blocks, this translates to 30 million barrels of net 2C contingent oil resources being attributable to Hibiscus Petroleum. This acquisition presented an opportunity for us to expand our footprint in an area of our geographic interest and is consistent with our 2021 mission of accreting value to all our stakeholders through the addition of production and proven reserves. As the operator of these blocks, we have established a dedicated project team in Kuala Lumpur coupled with a modest presence in Aberdeen, Scotland. The project team has been tasked with conducting the subsurface field development and engineering studies, and with the support of third-party contractors, successfully executing the concept select phase. A subsea tieback to an FPSO was determined as the preferred concept, and the final concept select report was submitted to the UK's Oil and Gas Authority, or OGA, for their review and consent in the previous quarter. We subsequently received a letter from the OGA in October 2019 stating that they had no objections with our preferred concept. We have now commenced with the front-end engineering and design phase to continue the progress towards establishing a field development plan, environmental impact assessment, and production facilities required for the development. The project will be executed in 2 drilling phases to optimise capital deployment. The first phase of the development will involve the drilling and production of 3 subsea wells in the Marigold field alone. In the second phase of the project, we anticipate that about 4 additional wells will be drilled in Marigold and tied back to the FPSO production facility. We have also identified several stranded discoveries around the Marigold and Sunflower fields, which we plan to tie back to the FPSO in subsequent drilling phases. We believe that potential collaboration with concession owners of some of these stranded discoveries located around our blocks is feasible and will allow a reduction in overall unit development and production costs for all parties. This slide shows the target timeline of the Marigold and Sunflower fields as we achieve key milestones towards our first oil objective from these assets. We purchased interests in the blocks in which these fields are located, and based on reports from third-party competent experts, they contain approximately 30 million barrels of 2C contingent resources net to the group. We paid $37.5 million for these interests. This results in an approximate acquisition cost of $1.25 per barrel. As previously mentioned, we have already finalised the development concept for the Marigold and Sunflower fields, and the regulatory authorities in the United Kingdom informed us in October 2019 that they have no objection to our proposed development solution. A schematic of the development concept is shown here. Given that the development concept has been finalised, our key milestone will be the securing of OGA approval for the Field Development Plan, or FDP. This will be followed by the achievement of the Final Investment Decision, or FID, for this project. Once the final investment decision has been made to develop these fields, we may farm out some of our interest in the Marigold and Sunflower assets. Our objective of reducing our interests is to ensure that we are able to fund the development of these assets without overextending ourselves from a gearing perspective. The key milestone will be to achieve first oil by 2023. In summary, we're excited by the potential value to be derived from the Marigold and Sunflower fields. We see this asset as a game changer for the group, boosting our net oil production rate and establishing the group as a mid-size E&P player. On the 12th of December 2019, we announced that AHUK had completed the sale and purchase agreement to acquire 100% interest in licence P2366 from United Oil and Gas plc and Swift Exploration Limited. The total cash consideration of up to $5 million is to be paid based on a combination of a series of milestones and an overriding royalty scheme. Licence P2366 contains blocks 1518D and 1519B, is located offshore in the UK sector of the North Sea, approximately 250 kilometres northeast of Aberdeen and 12 kilometres southeast of the Marigold field. It includes the Crown discovered field, which contains proven and probable, or 2C resources of 4 million barrels of recoverable oil. This transaction was an opportunity for us to aggregate 2C resources from the Crown discovery at a competitive unit cost per barrel and integrate these contingent resources as part of the Marigold area-wide development with the objective of reducing overall unit development and production costs. I will now pass you on to CY, who will take you through the financials of the group for the current quarter.
Hi, I'm CY, the group's Chief Financial Officer. I'll take you through the financial highlights for the current quarter. Sea Hibiscus became the operator of the North Sabah PSC on 31st March 2018. Accordingly, the current quarter represents the 8th quarter that North Sabah business performance data under the operatorship of Sea Hibiscus is being reported for detailed analysis. Earnings before interest, taxes, depreciation and amortization, or EBITDA, for the North Sabah asset is reported at approximately 65 million ringgit for the current quarter from the sale of 611,000 barrels of crude oil in 2 offtakes. Average realized oil price achieved was $47.72 per barrel compared to $70.19 per barrel in the previous quarter. Consequently, the EBITDA margin for the current quarter reduced slightly to 54% compared to 56% in the previous quarter. Additionally, average uptime in North Sabah in the current quarter of 89% was lower when compared to 93% in the previous quarter, mainly attributed to the repair work on the South Furious risers, which took place early in the current quarter. Average gross oil production was largely stable compared to the previous quarter, increasing by around 1%. The marginal increase in OPEX per barrel from $12.23 in the previous quarter to $13.16 in the current quarter was primarily due to the commencement of commissioning activities of leased equipment related to Phase 1 of the South Furious 30 waterflood project. The tax regime under which Malaysian oil and gas activities are governed and is thus applicable to Sea Hibiscus is the Petroleum Income Tax Act 1967 or PITA. The provisions of PITA are applied to net taxable petroleum income at a rate of 38%. Net tax charge for the North Sabah segment in the current quarter amounted to approximately 18 million ringgit, resulting in a profit after tax of 24.6 million ringgit. Turning to the Anasuria Hibiscus segment in the United Kingdom, EBITDA and EBITDA margin achieved for the current quarter was approximately 41 million ringgit and 74% respectively. Revenue recorded in the current quarter amounted to 54.8 million ringgit compared to 75.0 million ringgit in the previous quarter. The decrease was due to the lower average realized oil price achieved. Anasuria Hibiscus sold 239,000 barrels of crude oil at an average realized oil price of $50.59 per barrel in the current quarter. In the previous quarter, 250,000 barrels of crude oil were sold at an average realized oil price of $68.67 per barrel. Despite this, the segment recorded a higher EBITDA in the current quarter of 40.8 million ringgit as compared to 34.9 million ringgit in the previous quarter. EBITDA margin also improved in the current quarter to 74.5%. In the preceding quarter, it was 46.5%. This was largely driven by better operational performance in the current quarter, with the Anasuria cluster achieving an average uptime of 90%, against the 85% recorded in the previous quarter. Average OPEX per barrel of oil equivalent also improved to $14.92 in the current quarter as compared to $22.64 in the previous quarter. For the current quarter, profit after tax delivered by the Anasuria Hibiscus segment amounted to approximately 16 million ringgit. In the United Kingdom, the total tax rate for Anasuria Hibiscus is 40%, which consists of a ring-fence corporation tax and a supplementary charge at 30% and 10% respectively. A net tax expense of 2.9 million ringgit was recognized in the current quarter, a decrease when compared to the 5.1 million ringgit recognized in the previous quarter. The net charge in the current quarter was lower despite higher profit before tax, mainly due to a reversal of income tax liabilities recognized in the previous quarter and in the financial quarter ended 30th September 2019, subsequent to a reassessment of year-to-date income tax obligations. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels as long-term business continuity is of the highest priority. Our business performance is underpinned by several factors, predominantly the price of the Brent crude oil benchmark at approximately the time of a scheduled offtake from our crude oil storage facilities. Given that oil price is affected by global macroeconomic factors, which are not within the control of the company, Focus is placed on the operational performance of the assets, such as production rates and facilities availability, as well as the management of operational expenses. A key metric that we utilize to track our operational performance is average unit production cost. The average unit production cost for both the Anasuria cluster and the North Sabah PSC are well below the average realized oil price achieved in the respective quarters. As shown in slide 23, we have seen oil prices much lower and higher than current crude oil price levels, and we have managed on all occasions to remain profitable. The careful management of costs to maintain low operational expenditure and the delivery of production enhancement projects are key towards obtaining a low unit production cost structure. This is a significant contributor towards our profitability. We wish to reiterate that management's focus remains on delivering strong and sustainable EBITDA levels, as long-term business continuity is of the highest priority. Over the past few quarters, our balance sheet has been gradually strengthening, more so with the introduction of the North Sabah asset as part of the group's overall business portfolio since 31st March 2018. We have built our total assets to approximately 2.6 billion ringgit, and shareholders' funds stand at about 1.4 billion ringgit. Included in shareholders' funds are retained earnings of 503.3 million ringgit. Year on year, total assets have increased by 18%, while shareholders' funds have risen by 14%. Net assets per share currently stands at 86 cents. As at 31st March 2020, the group's unrestricted cash balance stood at 57.1 million ringgit. Note that approximately 40 million ringgit of proceeds from the North Sabah March 2020 offtake, which was received in early May 2020, was not included in the cash balance figure. The restricted cash recorded in our results relates mainly to a security for our portion of the estimated cost of decommissioning the facilities of the Anasuria cluster. In this regard, we are required to periodically place monies into a trust, and this commenced 18 months after the completion date of the Anasuria cluster acquisition. This activity will continue until such time that the security has been fully provided. In January 2020, the group drew down a short-term term loan for working capital requirements. In April 2020, the group signed a deed of supply and collaboration with Trafigura Private Limited, which covers several areas of commercial cooperation. Trafigura is a physical commodities trading company which is involved, amongst other things, in the sourcing, storage, transport, and delivery of a range of raw materials including oil and refined products. With the signing of this deed, the group and Trafigura have put in place a framework for the following. 1. Potential future offtake of crude oil by Trafigura from assets owned and projects undertaken by the group. And 2. Potential funding for projects and asset acquisitions pursued by the group. The agreements with Trafigura form part of an overall plan to ensure that all planned projects across the group are fully funded over the 2020 and 2021 calendar years. With the volatility seen in the markets over the past few months, we understand that lending banks are having to safeguard their existing client portfolios and may require some time before onboarding new clients once again. In this period, however, we will continue to engage with financial institutions and industry players to explore funding options and capital raising initiatives which run in tandem with our growth plans. Before we wrap up, I would like to hand over to Kevin to highlight a few takeaway points.
Hello, I'm Kevin Robinson, VP Special Projects. I would like to close this presentation with some key messages. As part of our business continuity plan, Hibiscus Petroleum has activated various measures to mitigate the spread and impact of COVID-19 within our organization, as the health and safety of our personnel remains of utmost importance. In the first 3 quarters of financial year 2020, we have delivered approximately 2.4 million barrels of oil. Whilst crude oil prices may currently be low, our production remains online and, barring unforeseen circumstances, we are on track to produce 3.2 million barrels of oil safely and efficiently. In addition, our asset plans have been activated to mitigate the risks posed by low oil prices. At North Sabah, the calendar year 2020 drilling program is set to continue with targeted optimization of both our operating and development expenditure. Furthermore, we have locked in about 50% of our total North Sabah production over the first and second quarters of 2021 financial year to provide the group with some certainty in terms of crude oil price levels and revenue generation. Specifically, we have locked in future sales of 750,000 barrels of oil at an average price of $35 per barrel. At Anasuria, we have made significant reductions in OPEX per barrel of oil equivalent in the current quarter to $14.9, and we are executing other initiatives which are targeting to reduce average OPEX per barrel of oil equivalent over calendar year 2020 to $18.50. Whilst our production is a continuous process, our revenue, however, is dependent on oil sales, which takes place via offtakes in each reporting period. Given the prevailing low oil price environment, we are reviewing the offtake schedule for both the fourth quarter of financial year 2020 as well as the first quarter of financial year 2021, and are assessing the benefits of delaying physical offtakes to take advantage of potentially higher oil prices in later quarters. In addition, we annually assess the carrying value of all our assets. The process for financial year 2020 has commenced with our asset and technical teams rigorously testing the inputs that support the carrying values. These inputs include, but are not limited to, several assumptions such as the long-term oil price curve, operating costs, and development expenditure plans. For financial year 2020, we expect to be particularly prudent and conservative in the inputs we apply in determining the value of each asset we carry on our balance sheet. In conclusion, we believe that the steps we are taking should protect our business continuity objectives in the near term, whilst our business development initiatives will provide us the opportunity to grow our asset base.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.